IRAs have a number of potential tax consequences for the account holder. It is important that they be properly informed about issues like early withdrawals, transfers, and rollovers. Mistakes in these areas can cost a consumer thousands of dollars, and the diligent producer will know the rules inside and out before selling IRA plans to their consumers. We talked about traditional and Roth IRAs and their similarities and differences. Some of the similarities: contribution limits are the same for both, and both will grow on a tax-deferred basis. That's about where the commonalities end, however. With a traditional IRA, there's potential for a tax deduction on contributions made to the plan, but a Roth never allows tax write-offs. Another main difference is the traditional IRA have the gain taxed upon receipt, but if a Roth has been open for at least 5 years and the owner is at least 59 and a half, the entire distribution is tax-free. There are some other distinctions too, and you will want to take the time to understand those differences for the test. We then looked at transfers and rollovers of funds. Transfers involve moving funds from one account to some other type of account. For example, when a person gets a new job and would like to transfer the funds in the old 401k to the new company's 401k plan. Rollovers, however, involve moving funds to a different type of account, such as taking 401k funds and rolling them into an IRA. You learn that it's a good idea to have direct rollovers, where the current holder of the funds sends the money directly to the new account trustee, and the owner of the funds never touches the money. Direct rollovers may be done on an unlimited basis annually. On the other hand, a consumer could request an indirect rollover where the funds are dispersed to the consumer. If this is the case, the institution will have to withhold 20% of the funds for tax purposes, and the account's owner has 60 days to replace the funds into the new account. The new account must have the entire disbursement from the prior account deposited, and not just the 80% that was received by the owner. This means that the owner will have to find the 20% that was withheld for taxes out of their own pocket. We finished the lesson with a look at 1035 policy exchanges, which allow a policy to be swapped for a like kind of policy and maintain their tax advantage status. It's a good idea to study what exchanges are allowed through a 1035 exchange, as it's likely you'll see a test question on that subject. One more lesson to go.